Welcome back to another episode of the Lofty Lenders Homebuyer Education, where we explore tips, tricks, and stories that help you plan for your next home purchase. Whether you're a first-time homebuyer, a move-up buyer, an investor, or just looking to learn, we hope you gain a little bit of knowledge today. Today, we are talking about what is PMI and how to avoid it. So, Charlie, PMI, that's like the public
Do-
mind integration?
Okay, that was terrible. Yeah, we don't do words well. But
Okay,
yes,
fine.
it's
What
it's
is PMI, Charlie? Can you tell me that one?
it's not as bad as what it used to be. That is the thing I guess I try to tell everybody. But generally speaking, it's when you put less than 20% down. So it's a risk thing. But it used to be awful. When you started, what do you remember PMI numbers being? Do you remember how much they were?
Well, first off, I want to let the first-time buyers know the PMI stands for private mortgage insurance.
Why would we tell
Because
them that?
I think it's important,
Okay.
but numbers-wise, I'd never really paid attention to it until I started over here. I just would push a button and I got the monthly payment, and
Yeah.
I'd never even thought about the percentages.
It used to be a lot more. I mean, I remember back in the day, I tried to pull up some old numbers, and I didn't keep those notes, and a lot of that's been purged. But it used to be to where you did everything possible. That's why you hear people trying to save 20% to get out of PMI. And in theory, that's a great idea. The problem is saving 20% is really hard, and you lose out on home appreciation. And so these days, even with mild credit, PMI is very inexpensive, and so it's very cost effective compared to what it was many years ago. So yeah, the theory of avoid PMI at all cost, it's not as effective anymore. You just wait too long, and then you just have to rent and not gain that appreciation and not have the pride of home ownership. So PMI is nothing to be afraid of anymore. We just want to manage it the best we can.
And I think it's really important to note that PMI is what it's called with a conventional loan. MI is what it's called with an FHA loan, which is just mortgage insurance. It's not private because it's through FHA. Excuse me. You're going to have an annual fee when it comes to a USDA loan, which is very similar to PMI in that you still pay it monthly. And the VA doesn't have anything monthly, but they do have a funding fee, which can sometimes be considered similar to PMI. So we use PMI, the term, very loosely in the sense that we talk about it with every different loan products. But even if you do have 20% down, if you have some sort of issue with your credit, it's possible you end up needing to go FHA. You're still going to have PMI. You're still going to have mortgage insurance that you have to pay. So it's maybe not the best thing to do to wait and save for 20% down. In fact, I almost can guarantee you it's not going to be the best thing to do, especially in a rising home environment where it's really hard to save 20% down because by next year, that house is going to be worth more.
Right. And we need to remember that back in the day when PMI didn't exist, you had to have 20 and 30 and 40% down because we didn't have Fannie and Freddie. We didn't have all these government-backed encouraging home ownership. You just had to cough it up. So if your local bank, which is where you got all your money, said yes, then you said, how much do I have to give you? And they gave you that number. So there was no option. So PMI is probably one of the greatest things for opening up home ownership that was created in recent times, because then you didn't have to have the 20%. Now you have the choice, but you didn't have to. So it opened it up to so many more people that didn't even have the ability to get to the 20%. It's just physically impossible with the income they made and their family expenses, whatever their situation. So it's really a huge perk that now it's just one of those things that, someday you can get out of it. And if we can get you to that point sooner than later, we'll do so, and we'll help guide you. But it's really a big perk because being a homeowner, you are going to grow your wealth that much faster than being a renter, because each month you're paying down your principal just a little bit and you're getting that property appreciation, which is a big number. I mean, year over year, even when you're conservative, that's a lot of money. You say 3% on a $1,000 house, you're gaining a lot of equity every year. So renting, you don't get any of that.
So to explain it, PMI is mortgage insurance that the mortgage company has in case you default on your monthly payments. So the reason that PMI was brought out in the first place and why it used to be more expensive and it's gone down a little bit is because numbers of foreclosures have gone down. And it's not a lot of times that we're seeing that FHA, Fannie, Freddie, USDA, they're having to purchase loans or buy loans back because the person that was making the mortgage payments, they stopped making those payments. But that PMI is set up as an insurance in case you stop making your payment. And so the 20% is really just a number that I'm sure studies were done, but if you've got that 20%, they don't have to charge you that mortgage insurance because they feel that, okay, you've got some skin in the game. We don't need to worry because if we end up taking that property back, we should be able to sell it for roughly 80% of the value, even if you kind of destroy it. But there's no guarantees on that either.
And that's the challenge. I mean, the 80% is kind of a BS number. Like it's a safe number that has been come up and used. But your keyword of, if someone leaves the house in less than ideal condition, and normally when you lose the house, you're not happy. So they tend to not leave it in great condition or they trash it. But you're going to lose a lot of that as the lender. So if you have a balance that is, I would tell you, and there's a lot of different research, but 60% of the value, if that's the mortgage amount, anything over 60%, the lender's probably going to lose. Because even if they can sell at that price, they have a lot of legal cost because the foreclosure process is not free for the lender. They have a lot of legal expense. And so, yeah, even if you put 20% down, if you go bad on that house, the lender's probably still going to lose. But if you put 3% down, they're going to lose a lot. And so that's where that mortgage insurance comes into play. So you can still get into that house with 3% down because the mortgage company bought insurance so they don't just take the complete brunt of that loss.
And you bring up something that I think was way more apparent to me when I first got into this business years ago. And I think it's gone down because I think the number of foreclosures has gone down as well across the country. But there used to be this myth or this thing that a lot of people would say that banks are in the business of owning homes. And banks are not in the business of owning homes. Charlie just mentioned it. The legal costs of trying to sell that house after they have to foreclose. I mean, you have to sign that mortgage at closing and it's 14 pages. And a lot of those pages just go through how and what they can do in order to foreclose and take the property back. But it also outlines the process that they're going to take to sell that house. It's a lot of work for them. They're not in the business of owning houses. In fact, when I was working at a bank previously, they had repoed a couple of cars. They're not in the business of taking cars back. They didn't know how to repo a car. They had the bank VP out there trying to repo a car and she had no idea what she was doing. And she certainly wasn't very scary if she showed up on your doorstep. So they're just not in the business of owning assets. And so then if they have to then take over possession, now, especially big box stores, they've got whole departments of people that monitor the property to make sure that, people aren't going to break into it. And
Empty
they're not gonna,
properties are a big risk.
yeah. And so they're trying to, get rid of those properties, but they've got to go through the legal process, takes months on end to do so. And they end up losing a lot of money. So the PMI is really there to protect them because they know it's there. But at the same time, if it's me, I don't really want you to have to pay PMI. I really don't.
Yeah, and we're going to do everything we can because there are creative ways to deal with it. But if you get into the house and you start having that appreciation, again, that's something we can revisit 2, 3, 4 years down the road as you improve the property and prices go up. There's lots of little things we can do to squeeze that PMI to come off as fast as possible. But it's much better to get into the house cost effectively with less than 20% down than it is to wait. I can't think of a single circumstance that waiting to gain 20% down, unless you happen to be getting an inheritance next month or something like that. Okay, that's a very short timeline, but normally that's 20% down takes a long time to save.
So there's a few different kinds of mortgage insurance, and I've kind of already mentioned a couple, but monthly is one. So that's probably the most common is most people just pay their monthly mortgage payment, and as associated a part of that is the private mortgage insurance. The next one is upfront mortgage insurance. So you're going to have single premium, which is you paying it. You're also going to have lender paid mortgage insurance, which is the lender is going to pay mortgage insurance by essentially giving you a higher rate. Usually upfront single pay for yourself is you just pay all of the mortgage insurance you were going to pay over monthly periods. You just pay it one time up front. That was really happening when we saw rates drop down to the 2s and 3%. You normally aren't going to pay 100% of that mortgage insurance. You get a discount. You pay about 80% of what you were going to pay over the life of your loan, which a lot of people took advantage of that and they're not refinancing. So it was really
one of my
great idea.
favorites. I mean, that
Yeah.
quite literally, when there was a point in time, and it's all based on price. It's like buying a 12 pack of Coke versus buying a single Coke. At that point in time, if you knew you were going to stay in the house long enough, hey, this is beautiful. It's a nice amount of savings. And so that's just a number of calc we have to run. Lately, in the last 3-4 years, it hasn't been priced as competitively, so we don't see it as much.
And I think when I first bought my house, Charlie, and you helped me do this back in 2014, lender paid mortgage insurance was only about a quarter point higher on the interest rate than just me paying
Very,
it.
yeah,
It
very
was
inexpensive.
right. So
Yep.
now it's not that. Now it's
No.
maybe a percent and a half. It's drastically different on the interest rate compared to just paying the mortgage insurance. And when you put them side by side, it just doesn't make any sense. But back then it did. So I'm pretty sure I had lender paid mortgage insurance because it was a quarter percent higher.
Most of the people I worked with did. I mean, there was reasons not to, but I mean, it was such a cost-effective route. And then when the lender paid where you built it into your rate, that got too expensive. Then we went through a stint to where the single pay was cost-effective, and we would do seller concessions. It's like, okay, well, we'll just have the seller pay it. You're going to pay a little bit more in the sales price. So you didn't roll it into your rate like the previous way. Now you rolled it into your loan and sales price, but it was still very cost effective. And then now that's kind of gone away because the monthly has gotten honestly very, very inexpensive. And like you said, there's not been as many foreclosures. So someday, if we see those foreclosures start to tick up, we're going to see the mortgage insurance go up. We don't see that right now. But again, it's just puzzle pieces. We figure it out. And that's the nice part. We keep track of that for you and we'll explain it. It's your pick, but it's nice to understand it.
Yep, that's why our spreadsheet is so key. And the final type, and Charlie, you and I talked about this before the show, but there is split pay mortgage insurance. And so split pay is typically when the lender will pay a portion of your mortgage insurance up front, and then you'll pay the rest of it monthly. And so we don't really see that too often. It's just really not a competitive thing where it's being priced into rates. And I don't even know if we have any investors that are willing to do it, but technically by Fannie and Freddie, it is
Yeah.
allowed.
I just thought of something because we talked about this that I don't have a lot of experience with it. It could actually come into play if we have a little bit extra money, but we're tight on debt ratio. So if your debts versus your income are off and the mortgage insurance, if we could drop that from, $80 to $60, that might be, see, we got something we got to check out.
There you go. In reality, I mean, if you were to take the extra $20 a month to drop down just the loan amount, it might not decrease your debt ratio enough to offset it. So that's
Yeah.
good to know.
Again, Kyle and I like our spreadsheets. We'll figure out how to make this easy to compare side by
We
side.
might have to cut that out, Charlie, so that way people don't get lost in my random mental math that I was just talking out loud there, but we'll see.
I know, but I got excited. Like, wait a minute.
So while home prices are still rising and many buyers are opting for lower down payments to stay competitive, PMI is it's really common. Don't get afraid about it. It is what it is. We're going to do everything we can. I will say it's also super important to have a low debt ratio. So one of our previous episodes, we talked about making sure that you have enough cushion in your budget so you're not house broke. Well, if you're not going to be house broke, that means that payment's fairly affordable. If the payment is fairly affordable, then mortgage insurance is actually probably going to be a little bit better. If we're at the top end of your budget and your debt ratios are maxed out, mortgage insurance actually becomes more expensive as well. They look at your debt ratio and they use that to determine your mortgage insurance. That's crazy. But if you've got good credit and you've got low monthly payment compared to your income, they're going to give you a low payment on PMI because you're just not as big of a risk to them.
Right there. It's back to risk, and everything is risk. The better you look, the less risky you are, the better the deal is going to be, which is how we present all of the options. It's like, okay, this one makes the most sense and here's why. But yeah, there's little pieces. I love squeezing benefit out.
So a few actionable takeaways. Number one, ask your lender to explain PMI options on the loan options you're looking at. Some conventional and VA loans have different PMI options, or FHA. Just explore those. Explore loan programs that require no PMI, or maybe upfront mortgage insurance, or maybe it comes off early, maybe portfolio loans that are out there. There's different ways to look at that. And then knowing your exit strategy. Even if you pay PMI now, you can remove it once you hit that 20% equities. Maybe it's waiting until you hit 20% equity with the existing loan. Maybe it's refinancing, or maybe it's looking at just contacting your servicer after a few years because the value in the area is increasing so much that you can refinance, and now suddenly you do have 20% equity because the value of all the homes has risen so much that you've got it.
Love it. Lots of good options. Just what's right for you.
Remember, you don't have to figure this out alone. Reach out to us at any point in time. We're always willing to help out. You can always go to our website, teamchedester.com. Be sure to follow us on all social media and subscribe to the Lofty Lender podcast for more buyer-friendly breakdowns, real-life success stories, and expert advice. And as always, stay curious, and we'll see you next week on the Lofty Lender.